May we be upstanding for the national anthem.
Dancing of Zambia, proud and free, land of wealth and joy in unity, victors in the struggle for our right. We won freedom's fight, oh, one, strong and free. Africa is our
May we remain standing as I invite Mrs. Janet Banda to give us a prayer.
Let us pray. Our Heavenly Father, we want to thank you for giving us this opportunity to see this day. Dear Lord, we thank you for the many blessings that you continue to pour upon our lives. Father, we pray even this morning that as this meeting is about to start, may you alone govern over it. In the mighty name of Jesus Christ, we have prayed. Amen.
Thank you very much, Janet. We may be seated. Allow me to acknowledge the presence of the governor, the deputy governors, members of the Monetary Policy Committee, members of the press, ladies and gentlemen, good morning. I welcome you to our second Monetary Policy media briefing for the year. As you may already be aware, the Monetary Policy Committee held its meeting on the 16th and the 17th of May, 2022. And this morning, the governor will announce the decision of the Monetary Policy Committee. Allow me at this point in time to also acknowledge the presence of our online audience, those who are following us through various channels. We are live on ZNBC TV2, Diamond TV, and the Bank of Zambia Facebook page. Those of you that are following us through these channels, we appreciate your presence. As always, the governor is accompanied by the two deputy governors. Deputy Governor in charge of operations, Dr. Francis Chipimo, on his right. Mrs. Reka Muhango, Deputy Governor in charge of administration, on governor's left. Next to Mrs. Muhango, we have Director of Economics, Dr. Jonathan Chipili. And next to Dr. Chipimo, we have Director of Bank Supervision, Mrs. Gladys Chiwele. My name is Bess Natmwanza. I will be your Master of Ceremony this morning. Without wasting much of your time, I will at this point in time invite the governor to address the press.
Thank you very much. Let me join Bessie in welcoming you to this morning's briefing, which is the second for this year. It's a real pleasure to have you all here. I know there are competing events going on at the moment, so we understand why some of your colleagues may not be here. Let me join Bessie also in recognizing the deputy governors, directors, Bank of Zambia, members of the Monetary Policy Committee, members of the media, welcome. Today, I'll run the presentation as follows, starting with the decision of the Monetary Policy Committee, followed by global economic growth. That will lead me to domestic economic activity and the outlook, spend a bit of time on inflation outturn and outlook, which is the main focus of the Monetary Policy Committee, interest rates, developments, domestic credit, money supply, fiscal policy performance, look at the external sector by focusing on the current account. That will be followed by some insight on gross international reserves, where we are. Then we look at what are the developments in the foreign exchange market. Then I'll provide the conclusion. At the meeting that we held, which Bessie outlined, which was from Monday to yesterday, the Monetary Policy Committee decided to maintain the policy rate at 9%. This is the second time this year we are holding the rate at the same rate. Then you may wonder what are the factors behind this decision. There are quite a number, but key among those are the following. One is a sharp decline in inflation over the past 3 quarters and the projection that it will trend towards the 6 to 8% target range by the end of 2023. We also took into account the positive efforts that we have observed in the implementation of fiscal consolidation measures that the government is undertaking. We equally looked at what is happening to growth in our economy, which continues to be somewhat subdued. Then we cast our eyes also on what is happening to the financial sector, in particular the vulnerabilities and risks that surround the sector. So putting all these together led us to the conclusion that it was appropriate for us to maintain the policy rate at 9%. Let me now delve a bit deeper into some of the issues. When we look at the global economy, I think the prominent issue that you see and hear, literally any media channel that you open, you colleagues who are in the media are even all too familiar. The discussion is on Russia-Ukraine conflict. This has dimmed the prospects for robust global growth. Commodity prices have risen. There are disruptions to a number of flows, not least the supply chains. We see also that the cross-border production networks and trade flows are equally affected. I think one of the chief areas of challenge is fuel. I think many of you will see that a number of countries have been affected by that. We are not spared in that regard because for one, we don't produce fuel here. We have also seen recently that there are adverse effects in the supply of such things as cooking oil on a global scale. So all these developments are weighing heavily on growth that was recovering from the COVID pandemic. In view of this, in April, the International Monetary Fund revised downwards the global growth forecast for both 2022 and 2023 to 3.6% from area forecasts of 4.4% and 3.8% respectively. In 2024, growth is projected to moderate to 3.4%. You recall that in not too distant a future, backwards rather, the projection was that the growth actually had recovered to 6.1%. So this is a major setback to the global economy, which obviously has ripple effects on the rest of the global markets. The key downside risks to the growth outlook, in addition to the effects of the Russia-Ukraine conflict, include emergence of more infectious variants of COVID-19. You can see here too that the infection rates are beginning to pick up, and for us there's even the issue of low vaccinations. But we see that inflation has been rising in advanced economies, notably the US, and in response to that, the central banks of these countries have resorted to tightening monetary conditions, and these have implications for the rest of the world. In particular, for us here, things to look out for is our reverse flows in capital. So this is something that we have to be prepared for. Now, on the right of this screen, you see the projections of growth, but I think it's what I've already explained. You see that there was that recession, and then it had rebounded, and then now we are down to where we are because of the challenges that I've outlined. Turning to our domestic economy, we note that from the high-frequency economic indicators, economic activity slowed down in the first quarter of this year. According to our own in-house publication here, which is the Bank of Zambia quarterly survey of business opinion and expectations, we see that the volumes of sales and the service, domestic sales, profitability, level of investment, as well as new orders declined during the first quarter. This is depicted in this chart, which brings out all the elements that we look at. This spider web, you see that the good position is when you are outside that web. Now, if you focus closely on what is happening here, is that the black, which is the dotted circle, so to speak, is showing the average for the whole. Now, if you look at the Q1 of 2022, which is the red one, the red line, if you follow that, you see that much of the points are within that circle from the previous quarter. They may be above the average, but when you look at the previous quarter, which is the blue circle, you see that they are inside. That's what we are referring to, that the economic activity slowed down during that quarter. So looking at that, you clearly see what I'm talking about. So the further out on the ring, the better the situation. But if you see, many of those are within the fourth quarter 2021. We also track the Stambic Purchasing Managers Index, which looks at how the economy performs. And we see that too is signaling weakening business conditions for the private sector. In particular, the new orders, output, and employment decreased. That is depicted on this chart 3. The green line shows that you are in a better position. Below that dotted line, the black dotted line, or should I just say that the dividing point or line is the 50 mark. So if you are above 50, is a positive development. Below 50 you are in some weakened position. So when you cast your eyes, if you will, to the right of this chart, you see that in March, this was actually below 50 mark, which was 49.6. But when we cross over to the current quarter for the month of April, we see some bit of recovery because that indicator is above the 50 mark. That in April, at least we do have some bit of recovery. Is still very weak. As you can see, it's very close to the dividing line, which is the 50 at 50.5. So this is hopefully the beginning of some recovery, and that is something which we took into account as we arrived at our decision. Then if we turn now to the outlook, we looked at the first quarter of 2022. Now, if we look over the medium term, we see that real GDP is projected to grow moderately. In 2022, we project that the economy will expand by 3.5%. And going on to 2023 and 2024, it is projected to grow at 3.6% and 3.9% respectively. This, we show it in chart 4 here. You can see that there are some modifications which have happened, obviously, following these challenges that I alluded to earlier on. So you see that if you look the one, I don't know if you are able to tell the colors, the one which is showing really low projection is the Focus Economics one, which is the lower one, which was done earlier this month. The IMF World Economic Outlook also shows some bit of a dip in 2022, a bit of recovery in the period ahead. As for us here, it's slightly a bit better, but not very different from what the IMF was also projecting. So all this is showing that our growth is still quite not very strong, is still quite vulnerable. And this is one of the reasons why we have to keep a close eye as to what we do to support that growth. Now, in terms of what really are behind these developments, particularly the growth that we are projecting, we note some sectors which are leading the way. Notable in this regard, we see the financial and insurance, information and communication, wholesale and retail trade, education, as well as the mining sector. So you can say that probably the primary sector which is really showing that it is rebounding is the mining sector, whereas agriculture is not featuring here. We'll come to that later on because we see that there are some risks in that space as well. Now, mining sector, I think it's important to recognize that there are a number of very positive developments that are going on. Recently, I think just last week in particular, we saw big announcements at the Indaba mining in South Africa. That is a very welcome development indeed. So we hope that these will translate in actual production on the ground to take advantage of the high prices of copper that we are observing at the moment. Prior to that, you also had the signing of agreements between Zambia and the DRC in the mining of copper and the other elements needed in the production of batteries and the accessories. So all those are pointing to a rebound in the activities in the mining sector, which is a very welcome development. But as I said, we need to see this happening and for us to get the benefits that are expected. Now, we note, obviously, that the Russia-Ukraine conflict, slow recovery in trade in partner countries, uncertainty surrounding the resurgence of new and more contagious COVID-19 variants amid low vaccination rate remain key downside risks to the growth outlook. So we have to remain vigilant to ensure that we take the necessary steps that, should these materialize, we are well prepared to deal with them. Okay, so now the main centerpiece of the monetary policy is really inflation. We did point out at the outset that the decision of the Monetary Policy Committee was guided by what we are observing in the actual outturn of inflation and the projection of the same over the horizon that we forecast, which is 8 quarters. Now, these point to some deceleration in inflation, but in doing that, obviously, you want to delve into the underlying factors that we are seeing. But just to see the picture that we are talking about, look at how inflation has behaved or in the recent past. The green line there is showing you the overall inflation, the black one, which is the middle of the two. The green one, that's the food inflation, and the red one, that's the non-food inflation. You can see that since Q3 2021, inflation has been declining, and declining at a fast pace. To help you follow the story, we have superimposed the actual movements on the chart. So you see that it moved from 30.8 to 24.5 to 60 to 18.9 to 16.1% for food. For the overall, or maybe let me start with the non-food, it moved from 15.6, 12.5, 11.5, 11.6. These are averages over those periods. Then we look at the overall, which is a combination of the two, food and non-food. You see that that has moved from 23.7% to 18.9%, and finally to 14.1%. Those are huge movements which we are tracking and are informing us as to what direction inflation is taking. So breaking it down in quarterly terms, the last column is actually what I was just showing earlier on, but we break it into two parts. The first part of that, we look at the averages, which is what I was talking about. They are 14.1, 16.1, and 11.6, the last column on that chart. Then we look the end period. Where did inflation end for each identified quarter? Again, if you cast your eyes to the right, depending on where you have to, mine is on the right, the extreme right column, you see that in Q1 of 2022, overall inflation was at 13.1%, food inflation was at 15.3%, and non-food inflation at 10.3%. We added another chart here. Usually we just show these two, but we thought that you would get a better feel of the contributions to inflation that we look at in this. So this chart actually also helps us to explain in some way what we call the base effects, which you hear about a lot in this conversation on the movement in inflation. So if you look at these bar charts here, the black line is that which traces the overall inflation. You saw it already. So in terms of contributions, you can see where the big weight is coming from is obviously from food. So if food is in good supply and the prices are coming, you can bet that inflation overall would be coming down. Non-food is important. In fact, that's one area where perhaps our monetary policy may have a more direct impact. But given that we import a number of things, even food inflation is affected by what happens in the monetary policy arena. So you see here the orange coloring there is showing the non-food, and the green, the food. Now, when I was talking about the base effect, look at Q1, for example, Q1 2022, and you look at Q1 2021. You see, when you are comparing the beginning point, which is Q1 2021, and the end point, Q1 2022, you see that the distance is narrowing. That's what, in effect, we are talking about the base effect. You see, there was that hump there. So as the year wears on, because you are referring 12 months previously to where you are at that particular point. So you see that the difference between those points is narrowing. That's what we refer to as the base effect. So you can clearly see that being shown here, what is going on. What are the factors we are talking about? Already I have alluded to the dispersion of shocks to prices of meat, products, and fish. We also observe some lagged pass-through from the appreciation. You know, when there is a movement in the exchange rate, there are what we say the first round effects, or the immediate impact that it has on the prices of various commodities. But it doesn't end there. As time goes by, some of those prices adjust with a lag. So this, we say that these show up at a different time. You see, when we come to money supply and the credit, when we try to control for exchange rate movement, you see the differences there very clearly. But here what we are saying that there are lagged effects of the pass-through from the exchange rate. When it appreciates, it does affect inflation positively, and when it depreciates, it pushes inflation up. The other aspect we look at here was that we had some improved supply of fish and the fresh maize during the period that we are looking at. This information is collected by Zamstats, and we look at it, but we try to track that because Zamstat has its own calendar, but for our day-to-day operations, we need also to have some information. So we do some weekly surveys of our own based on some of the sample basket that the Zamstats uses. And on that basis, we try to track where inflation is headed, and then give us the opportunity to undertake some open market operations to try and guide where money supply and where more credit could be provided, or where less is needed. So then we compare whether our forecast is tracking that well or not. So far, I think the tracking is very close. There are some differences here and there, but on the overall, there is a good tracking of that, which gives us confidence that what we are doing is consistent with what the Zamstat is doing. So what we see in April, which is subsequent to the quarter end, is that inflation actually declined further, in which, in fact, was for the 9th consecutive month that inflation has been falling. So we see that it reduced to 11.5% from 13.1% in March earlier. Increased supply of mostly vegetables, solid fuels were the key drivers of the decline in inflation that was observed. Now, remember I said there were two main factors which underpinned the decision of staying the course, as it were. One is what I've explained in terms of what the inflation outcome has been thus far. The other one now is the outlook. How do we see inflation evolving over the next 8 quarters? So what we see is that inflation actually is going to continue to trend towards the single digits. For example, in 2022, inflation is projected to average 12.5%, then drop to 8.9% in 2023. In fact, if we look at the quarterly movements, we observe that actually we would be within the target range of 6 to 8% by that time. But we are to remain observant because there are risks to this, which I'll come back to in a minute. But for now, again, is just to highlight some of the underlying factors to that projection. One of them is that we have, as I indicated at the outset, seen some enhanced fiscal consolidation, but going forward, we expect that that will take root, which means that there will be some beneficial effects coming from fiscal consolidation if we continue on the path that the Minister of Finance is currently on. But obviously, this is anchored on resolution of the external debt overhang. As you know, we have this challenge which led to us to default in 2020. We are still working on resolving this situation of debt restructuring. With some progress is made, but we are not yet quite there in terms of realizing that restructuring. We see that the support of the IMF through the extended credit facility is an important prerequisite for that. Here, I think I should state that sometimes we get questions that why are you hanging on to this issue of the IMF being catalytic for this restructuring that we are talking about. Colleagues, just look back in 2020 when we defaulted. If creditors wanted, they could actually have taken us to a lot of trouble. But the international community came up with this framework, in fact, 2 aspects of it. One was the Debt Service Suspension Initiative, which meant that all those countries who were adversely affected, including ourselves, we applied for this and we are granted. Given that umbrella, we could not service some of the debt that we owe. We currently service the multilateral debt, but we are not servicing the bilateral and the commercial. That was made possible by that framework. But now to get out of that, you need the common framework. The common framework is to get everybody to be treated in the same manner or equitably. So this is what we are at now. Having reached the staff level agreement in December, the next stage was to develop the debt sustainability analysis, which has been done, which will show at what point would Zambia be in what is termed as moderate risk of debt default. Now, to arrive at that, we need to engage in this structuring. You heard creditors clearly saying that without us having an assurance that our macro framework was sound, they will have difficult to come to the table to negotiate with us. So the SLA that we reached with the IMF provided that base upon which we could do. So the next step is that for the creditors now to form these creditor committees. The creditor committees have been formed. Now it's an issue of actually meeting and going through our debt sustainability analysis to see what relief do we need to get us to that position. So this is critically important because we had to engage, for example, the advisors for the debt and legal advisors also in terms of the legal implications of the action that we took. So a number of players are looking to the outcome of this in order for them to feel assured that they can move into our economy. So we are very glad to see that some of the investors, like the mines, have already taken that step, which means that they are looking beyond the current debt situation that we have. But obviously, with the expectation that we'll be able to resolve this in the manner that we have described. So we are all looking to this, and efforts are underway. But obviously, as the affected parties, we want this to happen like yesterday. But obviously, that's not within our control. We are working with others who are helping us and others who are also to provide the relief that we are seeking. So when we combine all these effects, our expectation is that these will boost market confidence, they positively impact inflation expectations, they will also result in macroeconomic stability, all of which are important to contribute to growth that, as I indicated, has remained subdued. So all these things are very important for us to get growth going, and going at a higher level than it currently is. However, we are not oblivious to the risks that lie over this inflation outlook. One of those is obviously the Ukraine conflict, which has pushed prices of energy and food way up. So how do we respond to that? I think this is an opportunity, it's a challenge, but also an opportunity for us to see what can we do, particularly in the food area. We have seen that there has been some there has been some decline in terms of the projected output for 2021-2022 season. But should that be the case in 2022-2023, I think that's something we can respond and we must respond to, so that some of these challenges which are being experienced, we can be able to resolve them ourselves. We see that this war obviously has other implications other than the global energy prices, but that again, we are urging those who are involved in this confrontation to down arms and talk and reach an amicable position. But again, that's not within our control. But what is within our control? That's what we should be asking ourselves. The other problem we see which could have a negative impact on inflation is these episodical outbreaks of infectious strains of this coronavirus. So when you just think that you are moving forward, you hear that there's a new strain that has been discovered. And that is putting brakes on some of the momentum that we were gaining in terms of doing things. Borders were beginning to open. Now other countries are beginning to think that maybe we opened too soon. All those have impact on the supply of commodities. When once they are constrained, it means that the prices of those commodities will go up, and that will lead to inflation. I already alluded also to the fact that because of rising inflation in developed countries, they are reacting by raising policy rates, and in so doing, that is tightening
monetary conditions, and that in turn means that they flows. Those who have capital are now gauging where is it safer to take, or where is it more lucrative for me to take my capital. So that has a tendency to adversely affect us. And we see this more prominently in the exchange rate channel. So that's one of the things that we have to be on the lookout, because as capital moves out, it means that they have to demand foreign exchange. In so doing, demand is increased, and without an accompanying increase in supply, you should expect that the price of the dollar kwacha goes up, and that's what we are talking about here. Lastly, one other effect is that the neighbors around, some of them were not as fortunate as we are in terms of the crop output. So we see that there could be some deficits in the grain production. Thankfully for us, we did have some surplus, though reduced from what it was last time. Now, that means that if the others now come to us to ask to buy some of our grain, obviously that is like to push up the prices of food, and obviously that will end up pushing inflation up. So that's what we are talking about here. So we have to remain vigilant. Now, turning to interest rates, which is the cost of money or the price of money, what we note is that during the first quarter of this year, these remained broadly unchanged. We note that, for example, the interbank rate, which is really the one we influence through the monetary policy decision that we make, remained fairly unchanged, around 8.92%, which was within the monetary policy rate corridor. What do I mean by that? This is precisely what I'm talking about. If you look at the red line there, that shows the policy rate. Then around it, we build this band where the top part, if it goes up there, then it's a signal that some action has to be taken to bring it back. Equally, when it goes below there, some action has to be taken. But what you note is that the green line there remained fairly close to the red line. That's what we are saying, that it remained within the corridor, and that is giving us confidence that the actions that we are doing are delivering on controlling that. But obviously, for the ordinary people, that's not where it ends. You are more interested in what happens to cost of money out there. Now, that is affected by a number of other factors, which we'll look at in a minute. But allow me now to just say commercial banks' average nominal lending rate at 26%. You can see that's quite a gap there. The spread between that is quite significant. And then when you look at on the deposit side, we just highlighted here the deposits for amounts exceeding 20,000 kwacha. This remained at 7.5%. So that difference, sometimes you complain that why is that? But again, if that goes up, it means that the lending rate will go up as well. But in between, there are those what we call negotiated rates. For those who have higher amounts than this, you can actually negotiate a rate from the bank which will be well above the 7.5% that I mentioned. Or you can also turn to investing in government paper, but as you see in a little bit, these have also been coming down, which we hope will weigh on this 26% that we are talking about. When you look at the weighted average treasury bill and government yield rates, they declined during this period by 0.3% and 0.2 percentage points to 12.7 and 21.7. So like I was saying, that if we are investing in these instruments, these are the returns that you'll be getting. You can see they are way above that. Now, we have made some progress in simplifying the process of participating by ordinary people in this market. So if you want more information, please reach out to our financial markets department. They'll be more than happy to do that. But if you feel you don't want to talk to anybody, go to our website and you'll be able to see some information on how you can do that, and you'll be able to get that. Now, when you look at the chart here, look at the green line. The green line here, this is the weighted average bond rate. And then when you look at the treasury bill rate is the one which is black. The red one in between, that's the average lending rate. Now you see an interesting behavior there, whereas the two, that is the treasury bill rate and the bond rate, are declining. The average lending rate is somewhat fairly stable, well, constant. I shouldn't say stable, because you might say, well, it's not benefiting me that much, but it's benefiting the banks. So what you see that all along, until perhaps October, thereabout, even the bond rate was way above the average lending rate. But because of what is happening in the fiscal space, this now is coming down, and coming down fairly quickly. For the treasury bill rate, in fact, you can argue that it's already in the negative real term. So what will tend to happen is that when that happens, people may move out of there and shift to that. But underlying this is really the fiscal management which is at play. When the government is managing its fiscal affairs well, you should see this stabilizing at some level. So what we are saying here is that these developments are important, but we need to sustain them for this rate to move down as you would want it to do. Okay. Domestic credit, which is one of the measures we look at to see whether there is money going to the economy. Two main channels. One is through the government, the other through the private sector. So what we see that total credit during this period that we are reviewing grew by 11.5% year on year. This is an improvement compared to the previous time when it grew by 8.6%. So the chart there is just depicting those that development. Now, importantly, is that during the previous quarter, private sector credit had actually did not grow. It, in effect, contracted by 7.8%. So in the quarter that we are reviewing, we see that it has moved to positive territory, growing by 1.4%. So this is an important matter for us in our decision-making process, that how do we nurture these to continue to grow? Because we are talking of the private sector being the engine of growth. So how will it be an engine of growth if this credit is not growing? So these are the issues that we are trying to influence through our actions. So the increase that we observed in the growth in the private sector credit came from the need for working capital to meet rising operational costs. You remember I mentioned that there are a number of challenges coming out of the Ukraine-Russia conflict. Now, how do businesses manage that situation? Is obviously to go to their banks and ask for some credit. So this is what we are seeing was going on during this period. So obviously our intention is that they must, going forward, also have that opportunity to do that. The other aspect we see that You recall during the COVID, high time of COVID pandemic, we had introduced the what we called targeted medium-term refinancing facility. Well, this has run its course. We made approvals close to the 10 billion mark, which was the amount which was set aside. Out of that, close to 10.5 billion has been dispersed. So this facility has closed because we think it has met its objective. We are, at the moment, reviewing to see what exactly happened when this facility was in thing. But importantly is that going forward, no more resources will be coming from this. So that's something which we were mindful of, that the players who were looking forward for that support would have to find other ways in which they can get support. So that can only happen if they can be accommodated by the banks and non-bank financial institutions at rates that they can afford. So what we see also here, while private sector credit grew during this period, be it in a modest way, on the other hand, the growth in government borrowing, the credit, slowed down to 16.8% from 17.9% in the previous quarter. Now, this was not by accident. This is the issue we are raising, that there are positive indications of fiscal consolidation. What we observed is that the government deliberately was limiting the issuances of securities to in line with a plan that they had laid out. So that is very important. That's what, if you will, an indicator of fiscal discipline, that you can get this money, but you say, no, I only get what I asked to get. So that's very important in terms of sending positive signals to the economy, and also for the government not to crowd out the private sector. So this is what we are pointing to when we say that there are some indications that the implementation of fiscal measures, fiscal consolidation measures, to be more precise, is taking place. But obviously we want this to continue for the period ahead. Money supply. So money supply is related really to credit that we are seeing, particularly from the government. What we see here that it contracted by 0.2% year on year. This was against a growth of 3.7% in December last year. So if you look at chart 10 here, this is what we are showing. If you look at the red line or the orange line, it's declining. Now, earlier, remember I said that you see the exchange rate influence. So if we strip that or adjust for that, this is what the black dotted line is showing. Now, you see that that's above that. Why? It's because last year we saw some significant appreciation of the kwacha. So these are lagged effects that I was talking about, which are manifesting themselves in how broad money is moving. Now, the slowdown in credit to government was the main explanatory factor for this outturn. Fiscal policy. I think I've said a number of things there, but just to stress one or 2 points, that from what we have been able to see, and the minister was actually also addressing the media the other time, where we see that there was improved fiscal performance in the first quarter of 2022, largely on account of revenue collections. It means that the revenue collections were quite robust during this period, and much of that came from the mining sector, this mineral royalty and other taxes. So, but a lot more is obviously expected to come from the economy. So that means ZRA and the Minister of Finance have to continuously look for ways of improving this. However, when we look on the expenditure side, we see that expenditure exceeded the target following a deliberate increase in spending on social programs. In other words, the government chose to spend a little bit more to social programs, which is, I think, what everybody had been saying, that what are we doing to the people who are not able to do that? So that's one way in which the government can demonstrate that is responding to this particular need. Obviously, the needs are much, much greater than the available resources, but we see a start in addressing this very critical area. For 2022 as a whole, we see that the fiscal deficit as a percent of GDP is projected to narrow to 6.7% from a preliminary outturn of 9% in 2021. So that trajectory of coming down is critically important for macroeconomic stability, which is an anchor for growth and other positive things in the economy. Further, looking ahead to 2023 and 2024, we see that fiscal deficit is projected to progressively reduce 6.3 to 5.2% over that period. Enhanced revenue mobilization measures and rationalization of expenditure reinforced by the debt restructuring under the G20 Common Framework underpin this projection. So that's on the fiscal side. And then on the external side, we look at just the current account. What we observe is that the current account surplus widened over this period. It moved from $1.1 billion to $1.3 billion. But when you do that as a proportion of GDP, however, you see that 1.3 represents a smaller part of that. Why is that? Because the economy is growing. When you look at the previous quarter, it was not as high. So growth is explaining why that share, the relationship, the ratio has reduced. But in absolute terms, it has gone up, which is something which players from outside especially look at, that where is the economy going in terms of its relationship with other countries. So this chart here breaks down the components of the balance of payments, and in particular the current account. You see the gray shaded, that's the current account, and you can see from the size of that bar chart that 1.3 is what we are referring to there. Gross international reserves. We note that up to end March, because we remember that we provide this with a lag, so the latest that we are able to share with you is end March, and we see that up to that point, gross international reserves increased to $2.9 billion from $2.8 billion. But when we look at how much can those reserves cover us in terms of imports, that's where we say the import cover. We note that the 2.9, as at the point we are measuring it, can cover us for 3.6 months. The 2.8, on the other hand, could cover us for 4.4 months of import. Then you might ask, why is that? With the more reserves, you have less import coverage in terms of months. The reason is that we look at imports from a projected point. In other words, every quarter, adjustments are made to the GDP and the imports. So we project that, and that's the figure that happens. So that this has declined, it means that imports have gone up because reserves themselves have gone up. So it means that the denominator, which is the imports, have gone up. That's why we are reducing to 3.6 months of import cover. Then where did these resources come from in terms of augmenting our reserves? Importantly, this came from the mining taxes, which are paid in dollars. This time around, we are receiving those directly. We are buying directly from the mines. The other one is that there were some inflows from projects that the government is undertaking. So those, when they spend, they convert the dollars into kwacha, and that becomes available as foreign exchange you can buy. Allow me here to spend about a minute or two, if not three, on this issue of mineral royalties and the mining taxes generally coming to the central bank instead of what used to be the case, that they were collected by the bankers to those mines that were paying taxes. This arose out of an observation that, firstly, we do have a monopolistic position here. There are not many producers of exportable commodities. The mines are a large player in that part. So when that was happening, that these resources go to the commercial banks, when the mining companies wanted to sell foreign exchange, obviously they will approach those banks for which they had accounts. And it was now those accounts, the banks which had those accounts, which will determine how they sell that. Now, our market is segmented. What do we mean by that? Well, the simple way to put it is that we have big and small banks. Now, all these obviously have clients who need these resources. But sometimes the relationship between the banks is one where they cannot trade between each other. So when we sit here, we can see that there is a foreign exchange, but it's not moving to where it is needed because the two parties or three parties have no operating arrangement. So we see that there is that challenge. Two, if as a central bank we want to buy foreign exchange, we would have to go into the market. And once we go into the market, it's very visible to everybody that, oh, the central bank is looking for that. So players there adjust their positions, and you may find that the exchange rate start moving. Now, thirdly, we are exporting copper, which is our main natural endowment. But for us to buy the foreign exchange, which is realized from the sale of that copper, we have to do it opportunistically, meaning we have to search around to find who can sell us that foreign exchange. Clearly, that's not a very sustainable position. Fourth, you look at the fact that, and many of you have been asking, where are the reserves? That number, it sends a signal to the players that if that number is declining or is less, it has implications for the reaction of the players. Because they say, your capacity to respond to a crisis is diminished. Fifth, having observed that, when the players in the market, remember I said there's segmentation, those who can't get from the others who have necessarily want to come to us and say, look, how can I get assisted? So where do we get the foreign exchange to assist those? It becomes a challenge. The other aspect is that, why do you keep reserves? one of the fundamental reasons why you keep reserves is to meet strategic imports. One of the major imports in our country is petroleum. Now, supposing the importers of fuel went to the banks and they said, look, we don't have any foreign exchange. A bank can afford to say that. It's in a business. I don't have it, ends up. But for you and I, when you go out there, you won't understand why the bank, you don't even care. You are just interested to see that there is fuel at the filling station when you go and want to fuel. So resources have to be found somewhere. And we stand ready to back up that by providing foreign exchange. So when we put all these together, we found that was the reasonable thing to do, to channel those resources through the central bank. There has been a complaint to say, well, maybe you are draining out liquidity in the market. That's why perhaps the exchange rate is moving the way it does. To the contrary, what has changed is the mode in which this money is seeing itself to the market. As you see in the next slide, we got, for example, in the previous quarter, $422 million through that channel. But out of that money, 372 million found its way back into the market. So yes, it wasn't available to Bank A because maybe it didn't come to want to get, but it was available to Bank C. So the mode of making these resources available has changed, but overall to the economy, the liquidity hasn't been drained as sometimes is portrayed. In fact, if you look at our previous presentation, where we give you the picture for the entire year, you see that a lot of those resources found themselves back into the market. So I spent a bit of time on this to clarify, because we have been having a lot of questions, notably from investors. This is what are you doing? But these are the factors at play. And we think this is a system which can deliver for us going forward, and we will stick with it until perhaps we see something different. The other thing I should stress here is that a number of times we are look at mineral royalty is 10% of the takings of the mines. But there's 90% which is not talked about. So we are fighting over the 10%. What about the 90%? Shouldn't we be finding ways in which that 90% can also be available for use in the economy? I think that's the task we have as a country, to see that we can claim part of that through supply of those items that the mining companies need. So I spent time there. Now turning to the last but one slide is the foreign exchange market. What we see is that during the quarter under review, the kwacha came under pressure because there was excess demand of foreign exchange in the market, and it depreciated by 3.7% against the dollar. Now, this is important to understand, that when there are these mismatches between supply and demand, they give rise to what we term volatility. So our role is to try to moderate or manage that volatility. Now, a number of times, what you observe for you when you go to your bank is an exchange rate, and as if when you want there, you can buy and think. But it doesn't happen that way in real life. What happens is that there are dynamics which are at play. So our role, Isaac here and his team, is to constantly monitor what is happening to demand and supply. When someone wants to buy foreign exchange, they will call their bank. Their bank may have the foreign exchange on hand at the time, and they will trade, no issue. But many times the bank may not have the foreign exchange that it has. So it has now to cleverly go into the market without exposing itself. So it will call who it deems has the foreign exchange it can buy. Now, sometimes these players also will have multiple bankers. So they will go to one and another. They are looking, for example, for $1 million. But you find that $1 million is being reflected in Bank A, it's also being reflected in Bank B. So when the system looks, it's like you have $2 million which is on demand. That sends signals into the system. Now, their role is to anticipate what would happen to this and then advise that maybe we need to support, and what is the reason for that demand. Is it an essential import or what have you? So all that thing has to be factored and be addressed. So the volatility sometimes you don't see is because it has been taken care of before it materializes. But there are gaps in terms of actions, in terms of when you can get the foreign exchange. So this is why when you have the resources that you need, you can very easily address that situation. So the bank stands ready to provide that kind of support. Sometimes there's overshooting. It can be on the depreciation side. It can also be on the appreciation. Now, remember, appreciation is good to you, at least as a consumer, but it's not good to the exporter because they get less for the dollars that they get. So it's a balancing game that you have to do. That's why our focus is to minimize that volatility, have stability, so that today you can comfortably go and exchange the dollars that you have with a clear view that when you come next time, you get it at about the same rate. But it requires a lot of work. So on the right here is just the movement in the exchange rate. So the last slide here then is a recap of what we did and why we did it. We decided to maintain the monetary policy rate at 9%. Why? Because when we looked around, we saw that inflation was continuing to decline. It's projected also to continue to decline towards the target range. So this gives us the opportunity to deal with other things. Obviously, if it was rising, we wouldn't be talking in the manner that we are talking about. So the committee observed too that fiscal policy was beginning to make some positive impact on what is going on the economy. So that is sending positive reaction to the market. We noted too that growth is relatively weak. Remember, our population growth rate is quite high. So growth rates of GDP of around 3%, 4%, it means that per capita terms, it's actually negative in some cases. So we can't address issues of poverty if growth is at those levels. We need to have higher growth rates. We also noted that there are lingering vulnerabilities and risks to the financial sector, which we must guard. When we defaulted as a country in 2020, a number of these banks adjusted their risk appetite for lending even to government. That will only be reversed if they feel comfortable that the macro situation is stable. So we have to continue to manage that in a manner that brings confidence to the market. Obviously, there are lingering risks too that we must be aware of. These are outlined below, which I highlighted at the beginning, so we are just bringing them back here for you to see where we are coming from. Thank you very much, and God bless.
Thank you very much, Governor. So there you have it. The Monetary Policy Committee has decided to stay the course by maintaining the policy rate at 9% for reasons very well articulated by the Governor. At this point in time, we are going to go for the question and answer session, and we will take 3 questions at a time. We'll take 3 from the audience that is here. As you may be aware, some of our colleagues are not with us here, but they have managed to send through some questions online. So we'll take 3 questions from here, and then we'll take 3 questions from our online audience. As always, those that have questions will have to walk to the microphone that has been set up for this session. Please state your name, state the institution where you are coming from, and you may then proceed to ask your question.
My name is Ivy Mwansa from Zambian Business Times newspaper. I'd like to find out how much gold reserves the country currently has. And secondly, the Bankers Association of Zambia has noted that the market has sufficient liquidity. So I'd like to find out what tools are used to determine that there is adequate liquidity and how these tools can be used at a community level. Thirdly, this is in relation to the $33 million payment towards the FTJ University. According to Matero MP, Mao Sampa, before funds are sent out on behalf of Zambia or the Ministry of Finance, the bank has to append their signatures. So I'd like to find out what role the bank played in this, considering the fact that the current governor was holding the same position at that time, and the deputy governor was a director then. Thank you.
We can take questions from 2 more people, if there are any.
Good afternoon. My name is Esnat Lungu from Spring TV. My first question is not different from hers on liquidity. We seem to have low liquidity in the economy from my observation. Then we can confirm that, and also what factors are leading to that. Secondly, from your presentation, and we've seen from other reports, it seems on the side of the macroeconomics in the country, we're doing well, looking at the going down of inflation rates, the way the currency is performing. But when we go on the ground, it seems that livelihoods are still, people are still struggling. Cost of doing business is still very high in Zambia. So what is it that we're missing as a country? Like, what do we need to do for us to have the positive developments that we're experiencing on the microeconomic side trickle down to the cost of doing business and the improvement in people's livelihoods? Thank you.
Thank you. We can have another question.
Good afternoon. My name is Cecilia Chilwa from Money FM. I would like to find out how far the bank has gone with the research on the introduction of a digital currency and some of the benefits of having a digital currency. Thank you.
Governor, you may take those questions.
As Bessie indicated, accompanied with the colleagues here, so I will take some, and my colleagues will also chip in to address some others. Perhaps let me address the tough one, which is the $33 million of FTJ. One of the things we have to appreciate is that as a banker, we have what you may call principal-agent relationship between the client and the banker. So in this particular case, who is the client, who is the principal, is the government. So as the bankers, we cannot disclose matters that affect customers, because imagine if it were you, I just come and he said, oh, do you know that how much Ivy has in their account, this is the amount they have, and so this is how they... It doesn't work that way. Besides, as a banker, you hold that money in trust for your customer. So when they come to us to withdraw, just like you go to the bank, you push a request, I want to withdraw money. So what you do as a banker is to look, well, is the person who is asking to draw this money the right person to ask? You remember when you open an account, you do sign what is called disbursement signature card. So it's no different from the government also. They are authorized individuals from the government side who are authorized to draw money on behalf of the government. Now, at a level of an individual, once somebody has drawn the money from the bank, it's not up to the bank now to start running after the client to say, where are you taking that money? What are you using it for? It doesn't work that way. So it's the same way when you have a principal-agent relationship with the government. When they withdraw the money, we go the card that they signed that who is authorized to draw that money. So we go to a banking department, they will pull out those cards and they check, are the signatures correct? If they are, fine. Then you go to look, does this account have sufficient money to meet that withdrawal request? If the answer is yes, that's the approval you are talking about to say, yes, you can go ahead and withdraw. But if the balance is insufficient, then you advise your client, you say, no, but wait a minute, much as you want to withdraw this money, it's not there. So you might as well deposit some more money for you to do that. So what am I saying? What I'm saying is that the relationship you're asking, the question you're asking me here, yes, we do that for the government. But for us to tell you where this money went, I think it's the principal who can tell you where they took the money when they withdraw. It's not now in our purview to follow that, what have you done with the money that you withdraw. This is an authorized person who have procedures on how to use the money that they withdraw on behalf of the government. I hope that answers your question. The colleagues at the ministry can give you more insights on what is happening. And if they ask us to give us the information that we know on the thing, we'll be more than happy to do that. I hope that addresses that issue. I'll be selective on what I carry because DGO and the Lazarus also be ready to deal, if need be, on the digital currency issue. I think we have 2 questions from opposite direction here which have been asked. One by Ivy, where she says that the bars inform that there is adequate liquidity. Then SNAT, it turns out that there isn't much liquidity. DGO, you wanted to try that, solve that Pandora. Eh?
Thank you very much. I think on the issue of liquidity, I mean, obviously, from the banker's perspective, typically when they say they have liquidity, it means either they have cash or instruments which are very near cash, which they can convert into liquidity. There is a question, of course, about how they then deploy that money. But I think I'll take you probably through to the presentation the governor made. And the first point probably to say is that I think if there's a theme through it, is being aware of the history. We have come from a period in which we had defaulted. The economic growth was weak. In fact, it was negative in 2020. And in economics, one of the most challenging things which we have to do is think about not just what's happening today, but how have policies you have taken yesterday impacting on what you're doing today and likely to impact on how the variables you want to influence tomorrow. And so what we really see is, so for example, the governor in his presentation noted that we had seen a decline in credit. To the extent that we were not, particularly to the private sector, we had not been seeing that lending going. It means businesses aren't borrowing, they're not spending, activity is down, and therefore money is obviously not going to be circulating to the extent you'd expect it to. But thankfully, I think the message in the presentation was that we've begun to see that uptick. So that's one issue which we hope going forward, to the extent that businesses' activity now begins to increase, that lending will increase, that the private sector lending will increase. This increase in private sector lending is also supported by the fact that government, which had been borrowing a lot, and some of those borrowing was to meet external payments and so on, obviously that was crowding out the ability of the private sector to pay. Now, to the extent that even in that borrowing, if you were accumulating arrears or not paying for goods and services consumed, again, liquidity was not going to the market. So one of the other things which is a story here is that although we have seen government borrowing decline, which is important, of course that may have some implication in terms of what spending is done. But one of the things which again we are quite noticing of is that we have seen, in fact in the presentation, I think there was talk about how on the expenditure side there was some increased expenditure on social sectors and so on. There was also been expenditure, we know, on clearing arrears. So again, the extent that these problems are resolved, we are likely to see some of this liquidity coming back into the market. The other issue, of course, is that when you have an environment in which the government yield rates were very high, the incentive for the banks to borrow, even though they may have to lend, even though they may have liquidity, is obviously limited. And I think Governor in his presentation showed that what we have seen now with the fiscal measures taken, government yield rates have fallen from, they were above 30%, maybe closer to 35, if we go back a few months. Now they are 21. The T-bills is even lower. As the government was saying, in real terms, probably even just a bit negative. So again, these forces are likely to then force the banks to begin to say, look, who can we lend to? And we need to be able to get that credit in. The other issue in terms of liquidity, again, is also there is, of course, some seasonality we see in currency. Laz may say something, but typically we're now getting to a period where we're getting into crop marketing. And typically what we tend to see in the regions where there's big agricultural activity, Eastern Province, for example, you begin to see currency demand rising in those sectors. We ourselves are trying to encourage people to use less currency, more digital payments, but in some areas, unfortunately, that is still not happening. But we're already beginning to see currency outside circulation trickling up. It had been falling, and for the year to date, it had fallen to something like maybe 5% reduction in currency in circulation. But we're beginning to see that, a year to date, it's about flat. On a year-to-year basis, it was about, year to date, it is flat. On a year-on-year basis, it had fallen a little bit. So what we expect to see now is that, in fact, currency will begin to, the demand for currency is picking up again. And so really, I think those are some of the factors which we can really look at. What we take comfort in is if we can lower interest rates, if the fiscal measures can continue and the private sector have better access to credit, our own action itself, if we had raised rates, probably would have been putting upward pressure on lending rates as well. So to the extent that we have not done that, we hope this environment will be able to support credit growth going forward. But again, it's about lags. It's about where have we come from. We don't expect to be able to fix everything in one day. Perhaps, Governor, I may just also mention about the gold. Gold, we are around 63 million US dollars is what we're holding in terms of the gold bullion.
Digital currency, you want to say?
Some work has gone on the central bank digital currency research that we are undertaking. The question was, what are the advantages of us introducing a digital currency? I think as everybody has noticed, the world over, most of the things are going digital. And as Zambia, we can't remain behind in looking at what is happening around us. We know already in Africa, I think Nigeria has already done it, and other central banks within the SADC region, in particular the South African Reserve Bank, is working closely with the Banking for International Settlement in looking at cross-border digital currency. So because of what is happening around us, we are not sitting idle. We are also looking at what do we need to do. So what are some of the issues we are looking at? We are looking at issues of policy. We'll also be looking at issues of legal requirements. What is it that we need to do to the law if we are to have a digital currency issued? We are also looking at issues of, are we going to have a wholesale or a retail digital currency? So all these are the issues we are trying to look at before we come up with our paper, which will be presented to the executive within the bank, and after that, definitely a white paper will be issued to guide on what we need to do going forward. Thank you.
Thank you very much. If I may just add a bit to what the Deputy Governor of Operations has said on livelihoods and all that. I think one of the things we have to bear in mind is that monetary policy is just one tool to resolve a number of the challenges that we face as a country. A lot of other things need to happen. So not one tool is sufficient for all things. So we are doing our part, as he has said, by maintaining the policy rate at this level. It's not a light decision, it's a very heavy decision, because if you look where the inflation is and where the policy rate is, others will argue that we are in negative territory, so how are you doing that? But we made a deliberate decision to stay at 9.59% to allow other things to take effect. Obviously, we are seeing fiscal coming into play now. We expect other structural measures to be taken to address some of the challenges that are happening. So it's concerted efforts at the end of the day. If we all did our bit, I think we can improve our livelihoods. Zambia is not in shortage of resources, but it's how are we using those resources. Creativity sometimes eludes us, but if we can put our creative caps on, definitely we can make our lives a lot better than they currently are. We have the space that can allow us to play that part. We are also maintaining the environment which makes it possible for you to do things without having to seek permission from anybody. So the challenge is to all of us, what can we do with our, I often refer to a human being as a sophisticated Swiss knife, you know? We have all these, I have 10 fingers. Each one of them is a tool. I have 10 toes, they are in shoes now, but if I removed them, each one of them is a tool. I have knees, they are tools. I have a head, it's a tool. We have eyes, those are things we can use. Are we using them effectively? That's the question we should ask ourselves. We are all given, without exception, 24 hours a day. What do we do in that 24 hours? I think that's what makes a difference at the end of the day. So we are doing our part. It may look not enough, but if we lean on to somebody else and somebody else leans on to the other, together at the end of the day, we'll be able to transform our lives. Nobody else is going to do it but ourselves. So I think those are the questions we had.
Thank you, Governor. We did receive quite a number of questions from our online audience, and most of them, however, were similar. There was a question on the position of our gold reserves, which Deputy Governor already responded to. There was a question on the digital currency, which Director Banking ably responded to. However, there's another question. What progress has Lazard Freres made in debt restructuring efforts? The other one is from Nduna Mwanangombe. It says, how responsive are commercial banks' lending rates to the monetary policy rates? I have noticed a correlated but non-commensurate trend of adjustments in the lending rates whenever the monetary policy rate changes. Is there a chance for Bank of Zambia to further regulate commercial banks' markup on the policy rates? Current lending rates are prohibitively high. The other question, are there any deliberate steps being taken by government in conjunction with Bank of Zambia to address the increased prices due to fuel?
Okay, thank you very much. Progress on debt restructuring, maybe I didn't say enough on this, but it's one of the slides we had in the presentation, is that we have done a lot in terms of preparing the ground for that conversation to take place. That is the conversation between ourselves and the creditors. But the prerequisite is for the creditors to form these creditor committees. As we speak, the official creditor committee has been formed, which comprises mainly members of the G20, in particular the Paris Club. That's the first in the order of doing the restructuring. You may have heard when we had the staff level agreement with the IMF that the next stage in terms of our program is to get financing assurances. This is what it means, that when this official creditor committee meets and buys into the proposal which Lazard has helped us put together to negotiate the restructuring, then they will make a pronouncement that they buy into that, and that will enable the IMF to go to the board. And then the process of actual getting the debt relief comes about. But in the meantime, with that agreement, the IMF will be able to release part of the $1.4 billion that they have put aside for the ECF. Equally, the World Bank and other multilateral organizations, once this hurdle is cleared, they will be able to provide what we term budget support to go to meet some of the requirements that the government outlined in the budget for 2022. So as we speak, the committee has been formed. So all we are waiting for now is when actually they will meet to start the deliberations. So there is progress. Like I said, as people who are affected, obviously, we are anxious. It's like, you see, if you are drowning, or maybe not, you have fallen into a ditch, and the people are looking for mechanisms to get you out. When you have a chance to say, no, I can't stay any longer here, but the people outside are working frantically to find a mechanism of doing that. That's how it feels, I'm sure, to you and to us who are close to the thing, that we wanted this to happen like yesterday. But there are processes that have to go through, we have to go through. Remember, this debt that we contracted was legally contracted. So we have to follow all these channels that the others want to be satisfied. Everybody's looking on each other, say that, no, what are you doing to it? That's why the common framework was arrived at, so that everybody is clear how we are dealing with each of the creditors, because no one wants to give a relief and the other one benefits. You know, in our profession we say we don't want a free rider. No one wants a free rider. That is somebody who doesn't put any skin in the game but gets the benefit. So it's very complicated. It's not that easy. And to bring all creditors who have different objectives in one room and they say, this is what Zambia is asking for, are you able to sign on to that? So let's hang in there. It will happen. And that will provide the relief way to them. I hope that answers that question. As to responsiveness of lending rates to MPR, I think here I also get some help from DGO or Director Economics, but what I can just say as an opening point is that these are not exact sciences, but also it doesn't just happen like that. You have to work at it for quite some time to start to begin to see those relationships. Now, we have been doing this, but then there have been leakages here, leakages there, which makes it difficult to put this. It's like you see if you are cooking in a pot and your lid has the hose, right? You are trying to contain the steam in the pot. If there are holes, you see steam escaping, and which will make it difficult for your food to cook in the time that you have done. So this is more like what we are doing. We are trying to close all these other loopholes so that when we say this, it has impact on the ground. But for as long as there are still loopholes, those will be exploited by those who see benefits from that. But that doesn't mean that we have to stop. We have to continue until we get to a point that is, when we say this, this means that. So I don't know if we can help this.
Thank you, Governor. Indeed, I think it's an important question which has been asked. So maybe I can approach it just to add on what Governor said in this way. Again, there was a chart the Governor showed in his presentation which had all those key rates. There was the policy rate at the bottom, and then you had the lending rate, which is the red one he was mentioning, which you'd see hadn't really moved very much, even though the government yield rates themselves have been coming down. Now, when we first introduced the policy rate, the idea is it's the base rate. And on the base rate, it's the basis upon a clear way in which it's the starting point for the lending the financial service providers do. On top of that, there's the margin. Now, the question of whether we should regulate the margin, because indeed, the first point you make is correct, that the responsiveness so far of the lending rate to the policy rate isn't as strong. For those of us who may have loans which are variable, which are tied to the policy rate, of course, when the policy rate changes up and down, you will see your loan change. But the key is that there's a big margin between the policy rate and what the banks lend. And just to take us back, initially when we had introduced the policy rate, that was the base rate, and then we did in fact introduce a cap. And this initially was set at quite a distance from where the lending rates were. But what happened from there? What we saw was that slowly, as the government yield rates began to rise, eventually they rose. They had started off very low, and so the policy rate was a good reference point. But as the government yield rates began to rise over time, as the deficits began to increase, eventually banks got to a point at which they were saying, well, why should I lend to you when I can just put my money in the government, who is giving me 20%, and as I said earlier, eventually gets to 30%. Why should I give you? So even if you cap, what happened then was that banks simply didn't lend you. Now, who are the people who really suffered? It wasn't probably the biggest firms. It was the small person who they simply said, I'm not going to take risks on you. And so that's what we saw. And so eventually when we came in, and I think when Governor came in his first term, we had a big relook at this thing and said, but is it really delivering this idea of caps? Is it delivering what we want to see, which is more credit? And of course it wasn't, because the banks were going to take other things into consideration. And so the question of whether we further regulate, for us, we can say there's evidence that we tried it and it didn't work. I think we need to address the fundamental problems which are driving these things. And if you address the fundamental problems, then you're not dealing with a band-aid. You'll find that over time you will make real progress. And so that's what we really see happening, and that's why the emphasis on what is happening on the fiscal, what we're beginning to see in terms of the yield rates, is very important for us to keep a track of. I think, Governor, that's where I would leave it. I don't know whether Jonathan would want to go into some of the empirical work done. But I think the point you make that there hasn't been much correlation is one which is accepted. Jonathan, I don't know if you want to add anything.
Yeah, thank you very much. Yeah, there's some work that is going on internally to the bank and also at the regional level. And one of these papers should be coming out shortly. But you could also look at what has been done for Rwanda and also Kenya. There's similar evidence that has been found. And indeed, the relationship appears quite weak because of the nature of the markets. But more importantly, I think lending rates is affected by a host of factors. And in situations where there's what is referred to as fiscal dominance, that tends to be a key driver or reference by the markets to set their lending rates. But I think the key point is that in our setup, we've highlighted that the shift in the policy rate should become a reference for transparency, because they're coming from an environment where there was vagueness about how commercial banks are determining their borrowing cost. So we insisted that to move forward and create transparency in the market, let's all focus on one factor which everybody is referring to as a starting point, and then the margin issue comes in, which reflects a host of factors. Thank you.
Thank you very much. The last question from the colleagues on the online was only if there are any deliberate steps that the government and us are taking to address the fuel prices. I hope you excuse us in that, because that's really now a different area of decision making. It's not in our court, as it were, to make those decisions. I think there are institutions which are better placed. The ERB does that. The Minister of Energy is also involved. So obviously the Minister of Finance from the financing side of things. So we get called if there is need for financing discussions, and we look at that. But I'm sure you have been following the discussions on these matters. Very recently, we had a very unique opportunity where 4 ministers addressed the media. And I'm sure many of you were there. You had the Minister of Finance, the Minister of Energy, the Minister of Logistics, and I think the Minister of Agriculture. They were all there, putting themselves available to you to raise any questions, and they shared policy direction in their respective areas. So these are important events that we must take full advantage of. Us here is one component that we do. The others is more advisory, and you can't go run to somebody that, no, go and ask him, I've advised them like this. I think that would be not very honest brokering, as it were. So these are matters which are amply and ably discussed by the respective ministries. I hope you appreciate that position that we are in. We cannot really go into that.
Maybe just to add a point, I think here the conversation the governor had in terms of the foreign exchange market, how we were trying to make sure that we could reduce volatility there, I think in that sense plays into this, right? Because we know that we can't do anything about the price of oil, but obviously we know that the ERB pricing system does take into account the exchange rate. And so to the extent that we can keep this relative stability in the exchange rate, I think that's an important contribution which is being made in this area. Thank you.
Thank you very much, Governor. We have actually run out of time, but I will ask, there's a question that is really outside of the monetary policy issues, but borders on the operations of the bank. And if you don't mind, Governor, I could invite Taonga to come through and ask his question. Taonga.
Good afternoon. Taonga Mitimingi from Bloomberg. My questions revolve around the cyber attack that the Bank of Zambia suffered last week. And I basically wanted to find out, did the attackers identify themselves or their motives? And if not, do you have any indications as to whom the attackers were and where the attack might have originated from? Lastly, was any of the bank's sensitive information compromised as a result of that attack?
I think fortunately we have Greg in the Director ICT. Maybe he can help respond to that in a better way than I can.
Yeah, Taonga, you will excuse me that I might not be forthcoming with a lot of details, considering that it's a matter that we are still managing. But for your own information, we know the attackers. It's a group called the Hive Group. They're quite common and with this kind of things. However, from our perspective, there is no much damage that has been done to our infrastructure. You might be aware that pretty much all our core systems are still up and running. Not much sensitive data has actually been shipped out. The impact that we noticed was just to a test environment. So the data that might be leaked out there is actually testing data for all intents and purposes. So we're trying our best to try and contain the attack. Thank you.
Did they ask for ransom?
Yes, it's a ransomware that we experienced. As you can imagine, a ransomware comes with a demand of money. But knowing that we had protected our core systems, it wasn't any necessary for us to even engage in that kind of conversation. So we pretty much told them where to get off because it's our data.
Thank you very much. So at this point, we come to the end of our briefing. Let me take this opportunity to thank all of you that made it to this briefing. Special gratitude to the production team from ZNBC as well as Diamond TV. Until next time, thank you very much and do have a blessed day. I will request that we be upstanding and allow the Governor and his entourage to leave the auditorium.